There is a silent battle that takes place in every trader's mind. It is not a battle against the market. It is not a battle against other traders. It is a battle between doubt and discipline, between impulse and patience, between fear and confidence. And few understood this better than Jesse Livermore. Livermore made and lost fortunes multiple times. He witnessed market panics. He dominated trends. He endured devastating losses. And through all of it, one lesson became painfully clear. Trading success is not built on intelligence alone. It is built on psychological confidence, the ability to trust your plan when everything inside you wants to abandon it. Confidence in trading is not loud. It is not emotional. It does not come from winning a single trade. True confidence is quiet. It is structured. It is earned. Most traders misunderstand confidence. They think confidence means feeling certain about a trade. But certainty is an illusion in markets. The market does not promise outcomes. It offers probabilities. Livermore did not trade because he was certain. He traded because he had a plan. And once that plan was defined, he trusted it. The psychology of confidence begins before you enter a trade. It begins with preparation, a clear system, defined risk, identified structure. If your rules are vague, your confidence will be fragile. Your emotions will control you. Confidence grows from clarity. When you know exactly why you are entering a position, whether it is a breakout, a pullback, or a trend continuation, doubt weakens. You are not guessing. You are executing. But here is where most traders fail. The moment price moves slightly against them, fear appears. They close early. They second guess. They look for new opinions on social media. They abandon their plan mid-trade. Livermore warned against this. He believed the big money was made not in the thinking, but in the sitting. Once the trade was placed according to plan, patience became the weapon. To trust your plan, you must first accept risk. Confidence is impossible without risk acceptance. If you are risking money you cannot emotionally afford to lose, you will never trust your system. This is why position sizing matters. When risk is small and controlled, perhaps 1% per trade, the mind remains stable. Losses become data, not trauma. A losing trade does not threaten identity. It simply becomes part of the statistical journey. Confidence is built through repetition. You test your system over 50 trades, over 100 trades. You see the edge play out over time. Wins and losses mix together, but overall growth appears. Slowly, trust replaces fear. But confidence is not permanent. It must be protected. After a series of wins, overconfidence can become just as dangerous as doubt. You increase size impulsively. You take trades outside your plan. You believe you have mastered the market. Livermore experienced this cycle repeatedly. His greatest losses came not from ignorance, but from abandoning discipline during moments of emotional excess. True confidence is balanced. It does not chase. It does not force trades, it waits. Trusting your plan also means accepting inactivity. Sometimes the best trade is no trade. The confident trader does not feel the need to participate every day. They wait for alignment, for structure, for confirmation. There is strength in restraint. Another element of confidence is journaling. Writing down why you entered, how you felt, and how the trade concluded. Patterns emerge. Emotional triggers reveal themselves. Weaknesses become visible. The market becomes less mysterious. And over time, something powerful happens. You stop fearing losses. You stop celebrating wins excessively. You begin to see trading as a process, not an event. That is psychological maturity. Livermore once noted that the market is never wrong. Opinions often are. When you trust your plan, you are not imposing opinion on the market. You are reacting to structure. You are following rules. Confidence does not eliminate emotion. It manages it. When volatility spikes and candles move violently, your heart may race, but your actions remain steady. Your stop remains in place. Your target remains logical. You act according to plan, not panic. This is the difference between amateurs and professionals. Confidence is not predicting the future. It is trusting your preparation. It is knowing that even if this trade loses, the next opportunity will come. It is understanding that your edge exists across many trades, not one. To trust your plan is to trust probability. To trust probability is to trust time. And when you trust time, fear loses its power. The psychology of confidence is not dramatic. It is disciplined. It is quiet repetition. It is emotional neutrality. And for those who master it, trading transforms from chaos into controlled execution. That was Livermore's greatest lesson. Not prediction, not timing, but trust. Every trader begins with excitement. Charts light up the screen, candles move rapidly, opportunities appear endless. The dream of financial freedom feels close. But emotion is a dangerous companion in the market. Emotional traders chase. They react. They double down after losses. They exit early after small profits. They trade to feel active. Discipline, however, is the opposite of excitement. It is boring, it is repetitive, it is structured, and it wins. The disciplined trader defines risk before entry. They know exactly where they will exit if wrong. They understand that being wrong is inevitable. Emotional traders believe losses should not happen. Disciplined traders see PT losses as cost of business. This mindset shift changes everything. Consider two traders entering the same breakout. One risks 5% of their account hoping for a quick gain. The other risks 1%, aligned with a tested strategy. When price retraces temporarily, the first trader panics. They close early or move stop irrationally. The second trader remains calm. Their risk is controlled. Their plan is intact. Over time, small disciplined decisions compound into large advantages. Discipline also means waiting for high-quality setups. The market offers endless movement, but not endless opportunity. Many moves are random noise. The disciplined trader filters aggressively. They say no more than they say yes, and this selectivity protects capital. Emotional traders measure success by frequency. Disciplined traders measure success by consistency. There will be streaks of losses. 3 in a row, maybe 5. Discipline ensures survival. Emotional reaction ensures destruction. Professional trading is less about brilliance and more about behavior. It is waking up daily with the same process, the same risk rules, the same patience. Emotion seeks alignment. And in markets, alignment always wins. Doubt is natural. Every trader feels it, especially after a loss. Questions arise. Is my system flawed? Am I capable? Should I change strategies? Without structure, doubt multiplies. Mastery begins when you stop searching for perfect systems and start refining one proven approach. Belief is built through evidence. Backtesting provides evidence. Data replaces emotion. When you see that over 100 trades your system produces net profit, confidence becomes logical, not emotional. Mastery also requires emotional regulation. Losses do not define you. Wins do not validate you. You are the executor of a process. The market tests belief constantly, false breakouts, sudden reversals, news spikes, but the master trader responds the same way every time. With rules. If stop is hit, exit. If target is reached, scale. If no setup, wait. No drama. No revenge. No ego. Over months and years, this repetition transforms doubt into quiet certainty. You no longer need validation from others. You trust your statistics. You trust your preparation. And eventually, trading feels less like gambling and more like engineering. Inputs, process outputs. Belief built on structure is unshakable. And when belief is unshakable, performance becomes consistent. That is the journey from doubt to mastery. There is a quiet truth about the financial markets that most beginners never understand. The market does not defeat traders. Traders defeat themselves. It is easy to blame volatility, easy to blame manipulation, easy to blame news events or algorithms. But beneath every blown account, beneath every sudden collapse of confidence, there is one common factor: emotion without discipline. The market is not emotional. It does not know your entry price. It does not care about your stop loss. It does not reward hope. It simply moves. And yet inside the trader's mind, storms are constantly forming. Excitement before entry, fear during drawdown, greed during profit, anger after loss. This emotional cycle is predictable, and unless controlled, it becomes fatal. Discipline is the invisible edge. It is not flashy, it does not produce dramatic screenshots. It rarely feels exciting, but it is the foundation of survival. Most traders enter the market with enthusiasm, not structure. They watch a breakout forming and feel urgency. If I don't enter now, I'll miss it. That thought alone destroys more accounts than bad analysis ever could. Fear of missing out is not strategy. It is insecurity disguised as opportunity. The disciplined trader experience has the same breakout, the same chart, the same potential. But instead of reacting, they check their rules. Is this aligned with higher time frame trend? Is risk defined? Is volume confirming? Is reward at least twice the risk? If any condition is missing, they do nothing. Doing nothing is power. The emotional trader believes activity equals productivity. The disciplined trader understands that selectivity equals profitability. There is a profound difference. Consider risk. Emotional traders rarely calculate position size correctly. They increase size after a win because they feel invincible. They double down after a loss because they feel desperate. Both behaviors are rooted in ego. Discipline removes ego from risk. Risk becomes fixed. Perhaps 1% per trade, no matter how confident the setup appears, no matter how strong the prior win was. Risk does not change because emotion should not change mathematics. When risk is stable, psychology stabilizes. A 1% loss is manageable. A 5% loss is stressful. A 10% loss is traumatic. And trauma leads to irrational decisions. The disciplined trader avoids trauma entirely by respecting limits before entering. Another area where emotional traders collapse is trade management. Imagine price moves slightly in their favor. They close early, they want to secure something. They fear the market taking it back. But when price moves against them, they hesitate to close. They widen stops, they hope for reversal. This is emotional asymmetry. Small wins, large losses. And that equation guarantees failure. Discipline reverses this pattern. Losses are cut quickly and without hesitation. Winners are allowed to develop. This feels uncomfortable at first. It requires patience to let profits breathe. It requires humility to accept small losses without protest. But over time, this asymmetry works in your favor. Large wins, small losses, and that equates. Ion guarantees growth. The disciplined trader also understands the power of routine. Markets open every day, opportunities appear constantly. Without routine, decision fatigue takes over. Discipline creates structure before the market opens. Review higher time frames. Mark key levels. Define possible scenarios, plan entries in advance. When price reaches those levels, action becomes mechanical, not emotional. Pre-planning reduces panic. Emotional traders live inside the candle. Every tick feels urgent. Every movement feels personal. Disciplined traders zoom out. They think in probabilities, not moments. They understand that no single trade defines them. This detachment is strength. Loss streaks are inevitable. 3 losses in a row can shake confidence. 5 can break it entirely if there is no discipline. But when risk is small and consistent, a 5-trade losing streak equals a manageable drawdown. The system remains intact, confidence remains logical. Emotional traders interpret losing streaks as personal failure. Disciplined traders interpret them as statistical variance. That difference determines longevity. Another hidden enemy of emotional traders is comparison. They see others posting profits. They feel behind. They increase risk to catch up. They abandon tested strategies for trending ones. Comparison creates pressure. Pressure destroys patience. Discipline blocks comparison entirely. Your account, your system, your statistics. Nothing else matters. Professional trading is not about being the fastest. It is about being the most consistent. Consistency is boring, and boredom is uncomfortable for emotional minds. But the market rewards boredom. It rewards waiting. It rewards repetition. It rewards emotional neutrality. The disciplined trader builds habits that reduce impulsivity. They journal every trade. They review mistakes weekly. They track metrics month. Heli, data replaces guesswork. Over time, patterns emerge. Not in the market alone, but in behavior. Maybe impatience appears during certain sessions. Maybe hesitation appears after drawdowns. Once identified, these patterns can be corrected. Self-awareness strengthens discipline. Without it, emotion remains invisible and destructive. One of the most powerful characteristics of disciplined traders is their relationship with losses. They do not seek revenge. Revenge trading is pure emotion. It is the desire to recover pride, not capital. After a loss, the disciplined trader pauses. They step away. They analyze calmly. They understand that emotional trades following losses have the highest probability of failure. So they wait. Waiting resets psychology. Emotional traders cannot tolerate waiting. They need action to soothe frustration. But action without structure is self-sabotage. Discipline teaches delayed gratification. It teaches that today's patience builds tomorrow's equity. Over months and years, this mindset compounds dramatically. Small controlled growth outperforms chaotic bursts of profit. The trader who grows 3% consistently each month with discipline will outperform the trader who makes 20% one month and loses 30% the next. Volatility in behavior creates volatility in results. Stability in behavior creates stability in results. The discipline edge is not visible on the chart. It is visible in the equity curve. Smooth growth, controlled drawdowns, predictable performance. That is the signature of discipline. And here is the ultimate truth. Markets will always tempt emotion. There will always be sudden spikes, sudden crashes, news events, breakouts that seem urgent. Emotion will whisper, "Act now." Discipline will respond, "Does it fit the plan?" The trader who listens to discipline survives. The trader who listens to emotion repeats the cycle of loss. In the end, the market is a mirror. It reflects your habits back at you. If you are impulsive, it magnifies impulsivity. If you are patient, it rewards patience. If you are disciplined, it compounds discipline. Success in trading is not intelligence versus ignorance. It is discipline versus emotion. And discipline, quiet, consistent, structured discipline, always wins. Every trader begins with doubt. Not the kind of doubt they show publicly, but the quiet kind that appears after the screen goes dark. After a loss, after a missed opportunity, after watching price move exactly as predicted, without them in it. Doubt whispers questions that feel personal. Am I cut out for this? Is my strategy broken? Why do others seem consistent while I struggle? This internal uncertainty is the real battlefield of trading. And yet, paradoxically, doubt is not the enemy. Unexamined doubt is. Mastery in trading does not begin with profits. It begins with clarity. And clarity begins with confronting uncertainty directly. Most traders search endlessly for better indicators, better strategies, better signals. They believe confidence will arrive once they find the perfect system. But perfection does not exist in markets. Probability does. And belief built on probability is far stronger than belief built on hope. The transformation from doubt to mastery begins the moment a trader stops chasing magic and starts building evidence. Evidence changes psychology. Imagine taking 100 historical trades using one structured system. Same entry rules, same exit logic, same risk percentage, no emotional interference. When you see, objectively, that over 100 trades the system produces net growth, something shifts inside you. Your confidence is no longer emotional, it becomes mathematical. This is where belief begins to solidify. But the journey is not smooth. There will still be losing streaks, there will still be weeks where nothing works. The difference is that now, doubt does not trigger chaos, it triggers review. The amateur reacts emotionally. The developing trader reacts analytically. They ask, did I follow the rules? Was the setup valid? Was risk consistent? If the answer is yes, then the loss is acceptable. If the answer is no, then the correction is behavioral, not strategic. This distinction is powerful. Mastery requires separating system flaws from emotional errors. Many traders destroy good systems because they cannot tolerate temporary drawdowns. They modify rules impulsively. They jump from one strategy to another. They confuse discomfort with dysfunction. But discomfort is part of the process. Markets are uncertain by nature. Even the strongest edge will experience variance. If you expect smooth growth without volatility, doubt will always dominate. Unshakable belief is built through exposure. The more trades you execute correctly, regardless of outcome, the stronger your psychological foundation becomes. Notice the wording. Correctly, not profitably. Correct execution matters more than short-term results. If you follow your plan flawlessly and take a loss, you reinforce discipline. If you break your rules and make money, you reinforce chaos. Mastery is about reinforcing the right behaviors repeatedly. Over time, this repetition builds identity. You no longer feel like someone trying to trade. You begin to see yourself as a structured decision maker operating within probabilities. Identity is powerful. When your identity aligns with discipline, doubt weakens. Another critical stage in building unshakable belief is emotional neutrality. Beginners attach emotion to every trade. A win feels like validation. A loss feels like failure. There, mood rises and falls with every candle. This emotional volatility creates mental exhaustion. Mastery feels different. Wins are expected but not celebrated excessively. Losses are accepted but not dramatized. You begin to see trades as individual data points within a long statistical series. Think of a casino. A casino does not panic after a few customers win. It does not celebrate wildly after one profitable night. It trusts its mathematical edge over thousands of outcomes. Master traders adopt this same perspective. They are not gamblers. They are operators of probability. This shift from emotional participant to statistical executor changes everything. But there is another layer to unshakable belief: resilience after failure. At some point, every trader experiences a significant drawdown, a period where performance deteriorates, where confidence cracks. This is the moment that defines the journey. Some quit, some spiral into revenge trading, others pause. They reduce size, they review data, they refine execution, and slowly they rebuild. Resilience strengthens belief far more than easy success ever could. When you recover from difficulty through structure rather than emotion, your confidence deepens permanently. You now know, not assume, that you can endure volatility. Another overlooked component of mastery is patience with growth. Social media distorts expectations. Traders see exaggerated gains, unrealistic percentages, and overnight success stories. Comparison fuels insecurity, but sustainable trading growth is incremental. Small, consistent percentages, controlled drawdowns, gradual compounding. Belief strengthens when you detach from unrealistic timelines. You understand that mastery may take years, not months, and that is acceptable. Because belief built slowly is stable, there is also a spiritual dimension to trading mastery, not in a religious sense, but in awareness. You begin to observe your own thoughts. When fear arises, you notice it, without acting impulsively. When greed appears, you recognize it, without surrendering to it. This awareness creates separation between emotion and action. You feel emotions, but you do not obey them. That is psychological maturity, and it is rare. The market constantly tests this maturity. False breakouts challenge patience, sharp reversals challenge confidence, extended consolidations challenge discipline. But when belief is grounded in process, not prediction, these tests become manageable. You trust your preparation. Preparation replaces guessing. Structure replaces chaos. Over time, doubt loses its intensity. It still appears occasionally, before major trades, during unusual volatility, but it no longer controls behavior. You understand that certainty is unnecessary. You only need edge plus discipline. Eventually, trading feels different. The noise fades. The urgency fades. The emotional roller coaster fades. You approach charts with calm focus. You mark levels, you wait, you execute, you manage. It feels methodical, almost mechanical. And yet, beneath that calm exterior lies something powerful: unshakable belief. Not arrogance, not blind confidence, but earned trust in your system, in your process, in your ability to execute. This is mastery. It is not dramatic. It is disciplined. It is built trade by trade, journal entry by journal entry, mistake by mistake. The journey from doubt to mastery is not about eliminating uncertainty. It is about becoming comfortable operating within it. When you reach that stage, something profound happens. You stop asking, will this trade win? And start asking, does this trade follow my rules? That single shift transforms everything. Because mastery in trading is not predicting outcomes. It is mastering yourself. And once you master yourself, the market no longer feels intimidating. It becomes a field of probabilities, navigated with calm, structured belief. That is unshakable trading confidence, and it is earned, not found.